You've probably heard about the Analyst Academy from Fundamental Edge by now. So instead of repeating the basics, let's talk a minute about what the Academy is and is not. The Analyst Academy is a practical course on the tools and skill sets required to succeed in the buy-side analyst seat. The instructors have experience from firms such as Maverick Capital, D. Shaw, and Citadel. But what is the Academy not? It is not a course on stock picking. It is a rigorous guide to learning and process. It is not a guide to pod shop investing. The Academy attracts a wide range of equity investors, from multi-managers to long-only to family offices. Rather than teaching a particular style, Fundamental Edge equips learners with the essential skills required to hit the ground running and support their PM. It is not a financial modeling course. Modeling is, of course, part of the curriculum and plays a central role, but the Academy is more than that. It teaches idea generation, thesis communication, and how to add value as an analyst. To learn more and access a 10% discount code, go to fundamentaledge.com/YAVP, or just see the link in the show notes. All right, hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review wherever you're watching or listening to it. With me today, I'm excited to have on one of Finchwit's favorite locked accounts, a true wild man, my friend, Matt Turk. Matt, how's it going?
Good. I think I might be the first person ever to be drinking on your podcast.
Hey, I love it. I mean, you're a true wild man.
It's 1 p.m. somewhere, and that somewhere is here. So,
well, it's 4 p.m. here. I'm Eastern, you're Pacific. I'm sure people can figure that out. Let me see. Before we get started, just want to give everybody a quick disclaimer. Nothing on this podcast is investing advice. That's always true. But as I said up front, Matt is a wild man. And if you follow this man, he will take you on some wild adventures. So just please remember, neither of us are financial advisors. Please consult one, do your own work, do your own diligence. This isn't investing advice. Matt, look, I'm so excited. You have I don't know if you want to share it or not. You've got a private video channel that I was watching.
Yeah, you can share. That's not locked. Yeah.
Okay. I'll include a link to the YouTube. Matt did one yesterday. Him and I are involved in a name, and I was so passionate and fired up about it. I was sending a message and be like, look, we've got to get you back on for a podcast to just go back over the name. So the company's Target Hospitality, the ticker is TH, and I'll just toss it over to you. What's going on with Target Hospitality and why are we so interested in them?
Yeah, so just to give you a brief update I've only known about this company for like 8 days, and Andrew actually is responsible for the reason why I know about it. He just briefly mentioned, we were talking about another name, and he briefly mentioned this to me as something he liked more, one of his favorite ideas right now. And the pitch was very short, and I took it, and then I started researching on my own, and I've become completely obsessed with this idea. Andrew could tell you I've probably spoken to him, I don't know, a dozen times a day since that day.
Hey, it's always nice to catch up with friends, but one of the great things is when you get into something, I think I'm the same way, but you get obsessed over it and read everything. And I like to think I'm the same way. You know, we're Googling, we're looking at everything. And there's one thing we'll talk about today that I had completely blanked. You know, you're reading 5,000 pages, you miss something sometimes. I completely didn't notice it. You sent it to me and I was like, oh my God, that's a wildly confirmatory bull point for the Super Bowl case. And I'll let you know what it's the special committee, but we can talk about it later, but please continue.
Yeah, so, you know, I don't know exactly. I'll start from the recent reason why we find it interesting. I guess I could speak for Andrew with a collective we with everything here. I think our views are very aligned on this. And then I'll go give you some history with Andrew also. Andrew actually knows more about the history than I do. But the most recent thing that happened was this company is owned by a private equity firm. They own 65% of the company. Okay. I guess I should tell you, it was a SPAC. So it was de-SPACed in 2019. And recently, on March 25th, the private equity firm put out a 13D that said they want to acquire the balance of the company that they don't own for $10.80. And the stock was trading around $9. And this is commonly referred to as a squeeze out, a majority minority squeeze out. And I love these ideas. I've invested in a lot of them over the years, as has Andrew. That's how it came up from Andrew to me. From there, I then started researching the last kind of 5 years on Target Hospitality, which we will discuss, and we might as well start from this background. I'll let you take it from there in a second. And, you know, the punchline of the story is I think the company is dramatically undervalued, is one of the only, could be the only special situation right now that fits a financial profile that's a traditional LBO. It's trading at 5.5 to 6 times EBITDA with no debt, And if you do traffic in the stuff that Andrew and I traffic in, most of these take privates are trading at teens multiples EBITDA, or 3, 4, 5 times sales with no real free cash flow. And especially in this debt market, you can't lever that up. Maybe you could do 1 or 2 turns, and even then you can't even service the interest, given it's already so expensive in the first place. With this, you can, and again, we'll get to it all, the numbers, but you can lever this up and take out the entire minority, the 35%, and put in 0 incremental dollars for the private equity firm. So Andrew, why don't you take it from 2019 and
so I'll do that in a second. I just want to emphasize one point you said, and this is one thing that when you hit on when I brought it up to you. You and I, as you said, we love to play these squeeze out transactions, and that's where you've got a private equity or sometimes corporate controlled company, and the corporate controlled company makes a bid and squeezes out minorities, and we love to play them. I didn't realize until you kind of told me, and we did some extra work on this, how rare these are. Right now, a lot of times you'll have a private equity firm own 35% of a company, 20% of the company, and they'll say, hey, we'd love to own the whole thing. But in this case, as you said, TDR owns 65% of TH. It is vanishingly rare for a company to have more than 50% ownership and to get taken out, except for MLPs, which are a very rare, unique case that you and I have also talked about and played in before. But it's vanishingly rare. One of the comps that we'll probably talk about later, if you look through their deck, a firm put together over the past 12 years, there's only been 13 examples that they could point to of someone who owned more than 50% trying to squeeze out minorities. So this is extremely rare. And the reason it's so interesting, and maybe the private equity firm miss one too.
And by the way, of those 13, only 2 of them were private equity firms. Usually it's a strategic. Think of I'm trying to think of the one that we recently, let's say Interactive Corp. This didn't happen. So I'm just coming with an example. Interactive Corp spins out Expedia or floats 20% of Expedia, and then decides after 5 years, this isn't working. We're going to buy it back to 20%. It's usually things like that. For a private equity firm to do this, think about it. I was thinking about it the last week a lot. They would have had to take a company public, float. This is what happens. They float 20%. It's public for years. It's a failed public company. They then would have to think that it's really undervalued and want to own the rest of it. And for all of those things that happen in that succession are really unlikely. So that's why it doesn't happen.
It doesn't have, and the other reason it's interesting is because if we own 25% of a company and we offer to buy the company out, well, the board could negotiate with a very stiff spine and say, hey, we've got 75% of other shareholders. Once you go over 50%, the board can negotiate. They've got fiduciary duties. Nobody doubts that. They're going to get sued if they don't. But if they negotiate too hard, then the private equity firm can just say, cool, we own 65%. We are replacing all of you, right? So they actually have control. So these are very different than, there are several out there where a private equity firm owns 20, 25% and makes a bid. So just wanted to point that out. Let's talk history. This was a D-SPAC. Forget the D-SPAC, right? That's far in the past. That was 2018, 2019. I think one thing important to note in the history is in 2020, post-COVID, mid-November 2020, TDR, the private equity firm here, the stock was trading at $1 and TDR lobbed in $1.50 per share bid. And that eventually got rejected for a whole host of reasons. We came up with a vaccine, the stock market raced, and all the minority shareholders pushed back and said, you're trying to steal the company. It didn't work. The only reason I think that's important is because it shows that this private equity firm is, when they see value, they're really willing to pounce. And look, the stock is 10 right now, and they offered to buy it for $1.50 4 years ago. That would have been a grand slam if they could have done it, right? So it shows that they're thinking. Let's fast forward to last year. One other thing. In 2020, when this was a D-SPAC, this company provides temporary housing. And the way it used to work, and they still do this, is if you're an oil and gas company and you're drilling in the middle of Texas and there's nothing there, you would contract out with Target Hospitality or one of their competitors, and they would bring a lot of temporary facilities in, and they're going to provide lodging for your workforce. Your workforce needs to live there. They're going to provide food. That's what they do. 2020, it was 67% oil and gas, right? That's very cyclical, obviously. 2021, 2022, they start developing this big government business of housing migrants who come over the border, particularly unaccompanied minors and particularly unaccompanied minors. So they've got a big migrant business, and this grows incredibly because of border crisis, all the stuff you see in the news, right? It grows like crazy. So those are important backgrounds because in 2023, This was an event dressed investor's dream stock. I can't tell you how many people were pitching this to me, and it was a very good thesis. I almost had several of them on the podcast where they said, hey, Andrew, the stock is at 15, the stock is at 16. There's a migrant crisis. They're going to win. The government's out looking for new temporary facilities to host all these migrants. They're going to win several bids.
And it was only trading at like 5-6 times EBITDA at 16-15.
Exact. Absolutely exact. So they said, hey, your downside is low because this is low multiple. They're generating tons of cash because the customers basically pay for the CapEx, generate tons of cash, low multiple with this huge upside if they want to bid. Fast forward to the end of 2023, the government, from memory, is bidding 3 different contracts. And the bull case was they're going to win all 3 or maybe 2, but even if they just win 1, that's going to be great. They win 1 contract, but then they reveal the terms, and the terms are not what anyone expected, right? Lower margin. There was a little issue with previously they'd gotten paid for CapEx. Now that the CapEx is installed, they're not getting it. Stock sells off like crazy, goes from 15 to 8. Now every investor is out, right? And I think that's pretty much the basic background of, hey, the stock gets killed, EBITDA kind of resets, and then your 65% owner says, hey, this company looks really cheap. There's a lot of call options we can talk about. Let's try and take them out. I don't know. I miss anything? How do you think I did?
No, that's exactly what happened. There's some very interesting. This is such a weird situation. I don't know. Even you and I have never talked about this, but this private equity firm is European based, and if you go to their portfolio holdings, they don't have a single company that's in America except this one. Every single position is European based, and this is like an inherited position from Arrow because they acquired Arrow, an investment management firm, a few years ago. And this legacy position goes back for them to 2012. So this is a stale fund that clearly needs a kind of a secondary transaction or a complete sale. So there's an impetus for them to do something with this position, mostly because they don't do America. I mean, it doesn't make any sense why they even have this.
Well, that is one of the other interesting things is you're the one who jumped on this much more than me, but if you compare their 2020 letter, when they offered to buy this thing for a song during COVID.
I have it right here. I was going to do it. Yeah.
They said, why don't you go through it? You know where I'm going.
It's just really interesting. It's very rare that you'd be able to have to compare 2 letters, right? Usually these things, a majority bids for a company. If it's an MLP, forget it. There's no provisions. We could talk about the differences between this and that, and it's all very relevant. But to be able to look at the letter from 2020 and the letter from 2024 and see what's there and what's not, when it's the same exact firm trying to buy the same company, is totally riveting because there's parts in it that are omitted in the 2024 letter that were in the 2020 letter. And you could really only come up with bullish reasons for the omission. So I'm going to read you 3 paragraphs from the 2020 letter. And the spoiler alert is all 3 of these paragraphs were deleted from the 2024 letter. So focus on that. This is not there in this letter, okay? It is our expectation that certain key members of management will roll over their equity in connection with the transaction. Given the Arrow Group's existing controlling stake and history with the company, we will need to perform only very limited due diligence prior to executing definitive documentation. That last sentence, they have something kind of like that, but the other one, they don't. There's no management rollover. These are the 2 important ones. Our proposal should not be construed as an interest in participating in any alternative change of control transaction involving the company. The Arrow Group has no interest in selling the control of the company at this time. We emphasize that neither the failure of a special committee to recommend a transaction nor the failure of the company's public stockholders to approve a transaction would adversely affect the Arrow Group's ongoing relationship with the company. The Arrow Group intends to remain as long-term stockholders of the company if a transaction cannot be completed under our proposal. They deleted all of that. The rest
and just remind listeners, that was language from the 2020 letter when they tried to take the company private on the cheap. All of that was deleted from the 2024 letter, which they're trying to take the company private now. Please continue, Matt.
So many fascinating things about this, okay? The reason why you put the first thing, which is that you're not willing to sell to anybody else, is you don't want a competitive bidding process because you don't want to bid against other people. Because if you own, as Andrew said, if you own 25% of a company, well, even if you tell them that you're not going to sell your 25% stake, you don't have a blocking stake. Yes, it's hard probably to get around that 25% stake, but if the price is high enough, you probably can get 51% of the 75% to vote for a deal. The closer you get to 50%, the less likely it's ever going to happen, right? So you almost always put that in there. You say, I love this company. I'm not selling this to anybody. Take my crappy bid, maybe a little bit of a bump. We'll talk about the dynamics of how these things usually work, but take my bid or take nothing, okay? That's gone. The second thing that is almost always in there is we're not going to be mad at you if you don't agree to our terms. We're not going to be mad at the special committee. We're not going to be mad at the public shareholders. We love this company and we're long-term shareholders. They deleted that from the letter. Why? They own 65% of the company. Clearly, if they don't agree to their terms, they're going to be long-term shareholders unless they sell the company to a third party at a much higher price. Now, that dynamic is weird because they could have just run a private process. I mean, they control the board. So if they really weren't interested in bidding, this isn't like a stalking horse bid. I think they genuinely do want to buy the company. But something is going on here. And I noticed in the proxy that came out last week that last year, there was a special committee form. They won't tell you what it was for, but it says that board members were paid a premium to be on this special committee from July through October of last year. Now, that's also around the time they were doing the bidding for this very important project. And it's possible that the board was involved in that bidding process, but that's really a management thing, not a board level decision. So my gut tells me that they either ran a process then or this private equity firm was interested in bidding then, and they could not come to an agreement on terms and they dropped it. Just to be clear, there's no real set way a majority firm has to go through the way to acquire the minority. So there's a lot of different ways to look at this. You could look at Silver Lake, for instance, just bought Endeavor. They only owned, which was a big position of Andrew and I's, they only owned a third of it, but they controlled it. They had 65 or 70% of the vote, okay? They put a 13D out back in October, and they said they want to bid for it, no price, and they're not going to sell to anybody else, okay? They also didn't say that the bid would be subject to a majority of a minority vote. I should just describe what that is. That means exactly what it sounds like, which is anybody that's involved in buying the company cannot vote. And if you are being taken out, you do get a vote. So in this case, 65% of holder can't vote, but the other 35%, they have to get the 51% of that 35%. I don't know if it's a simple majority or a voting majority. I don't know which one it is, but
I believe it's simple majority of the votes. And just to be clear, this is something that they put in, it's a fairness thing, right? They can't jam it through and say, forget the 65%. Let's go back to EDR. I own 35%. I get a deal over the finish line with 51% of the votes. And I say, look, we're heroes. And then everybody says, well, 20% of the minority shares voted yes, 80% voted no. You only got it over because of 35%. Opens yourself to lawsuits. It doesn't look good, all this sort of stuff. You include the majority of the minority, so you could go to anyone and say, hey, look, all the unaffected minority shareholders, they voted yes for this. 51% of them did. The majority of the minority wanted this.
EDR wasn't 35. They had a 70% vote. So they didn't even have
they owned 30. Yeah. EDR had you and I just figuring out the share count there was kind of tough.
And on a side note, we could do a whole podcast on EDR. I think they're going to have huge lawsuits. I'm going to get to that in a second. So the reason why, in this letter, in the 2020 letter and the 2024 letter, they explicitly have a paragraph that says they will only go through with the transaction if an independent special committee approves it and a majority of minority vote approves it. It says that's non-waivable, okay? The reason why companies do this is you're almost certain to get lawsuits after the deal closes. Delaware has a huge history and precedence with fairness for takeouts involving majority shareholders, whether it's 51% or 40% or whatever it is. If they don't do those two things, there's an acronym for it, MFW or something like that. You would know better than I would. You know the acronym?
I actually don't know the acronym.
It's based on a famous court case that Delaware law said, if you don't do those two things, you are subject to litigation. So it's always super interesting, and there's another podcast for this. It's always super interesting when they don't do that. And in fact, 2 of the 12 examples that Andrew had on that list of majority minority squeeze outs that were private equity firms did not agree to a majority minority vote. They were huge premiums. One was like 120%. One was like 80 or 90%. Guess what? One already settled the lawsuit for $20 million. And the float they took out was only $250 million. So that's an 8% bump minus lawyer fees for them not
lawyer
doing,
fees are a big asterisk there, right? But to them, it's an 8% bump.
Yeah. 8% bump of what the company had to pay. Exactly. That's their money out of the bank. Okay. The other one, lawsuits are pending. Okay. 2 out of 2. Okay. So you always do that, but it subjects you to maybe not getting the vote. And that's where I think I'm going a little bit off kilter, but it's very important to the story. So this one is great because this one has 2 5% shareholders, both, I think, pretty savvy firms. They're not kind of, not to be disrespectful, but they're not kind of sleepy long only, index funds or mutual funds. It's not Fidelity that's owned this for 25 years. That isn't, they're not active managers. These are active managers, and they own 5 and 6% of the company. And I can assure you, and I'll give you an example why, that they are very interested in this being acquired at the right price.
I want you to give the example why, but I do just want to add one thing. We mentioned that TDR owns 65% of these. Normally if you've got a 5% shareholder, they carry some weight, but here you have 2 5% shareholders. So add them up to 10%, right? Only 35% of this company floats. So these 2 with 10%, them alone are almost a blocking stake for the majority of minority consideration. They are going to carry enormous weight if and when a final deal comes like this. And I'm just kind of pointing out again, 5% normally say, oh, that's a nice sorting, but here it is enormous because of how small the free float is.
And it's not 10, it's 11%. And I think it might be more by now, by the way. I'll get to why I think that. And also to be clear, that 35% can vote, but usually in a proxy, 50, 60, 70% will vote if it's kind of even a hairy proxy. So you're probably only looking at 20 to 25% of the shares voting. 11 is pretty much a block. You add Andrew owns like millions of shares. No, I'm just kidding. But if you add all the whales between the two of us, we have
Matt is 100% joking. No one listened to anything he just said there.
Andrew's disclaimer at the beginning should have been, none of this is advice. If you're going to sue anybody, sue Matt. That's your advice.
You said it, not me. You said it, not me.
So the bid, the majority shareholder bid on March 25th. On March 26th, the second biggest shareholder, who we knew owned 4.7% as of December 31st, because they file quarterly reports like all major investors do, they filed a 13G, not a 13D, a 13G. A D is when you're active, a G is when you're passive. Now, there's so many interesting dynamics about this. Usually you have to file a 13G. It's like 10 business days after you cross the 5% threshold, okay? And no one ever rushes to do this, okay? They did it the next day. So on March 26th, they filed 13G. They say the date of filing that they needed to notify you was as of March 25th. So they definitely bought stock on March 25th. Now, we don't know how much they bought from January 1st to March 25th, because the last filing update was December 31st. It's only a few 100,000 shares that got them to 5%. They had 4.7 million. Now they have 5.1 million or something, right? So I didn't even notice this at first, but my first thought was, okay, they did this for just for one main reason. Once you file the 13G, they can now go up to 9.9%, and they never have to file again. Okay, they have to file quarterlies. So March 31st, we'll find out what they own, but we won't know what they own again. I mean, we'll find out May 15th what they own March 31st. Yep. But we won't know again until middle of August what they bought in March. What they bought in April, what they bought in May, whatever. So I thought they were like, hey, let's get the 5% so we can notify the public we're there. And then we can be kind of stealth and keep buying more stock around the bid at price. We haven't even talked about where the stock's trading and all that stuff. That's obviously the most important part of this thesis. But that way they can keep accumulating every day, and they're more likely to block. By the way, talk about make your own catalyst. They know they're not legally allowed to communicate or form a group with the other 6% holder. But I can assure you they've spoken. And it's totally legal to speak. They're not trying to acquire the company or anything, but they can definitely talk to each other and say, we think this is worth X. This is how we're thinking. And I'm sure, I don't even know these people. Never met them, never spoke to them, never emailed them. So this is just me hypothesizing. They're speaking to each other or have spoken to each other. And it definitely behooves both of those groups to buy as much stock as they can to have more of a block and more of a say on what this is worth. Okay, so yesterday, I didn't find this, Andrew. Somebody else told me this yesterday. It was in the 13G, when under purpose of transaction, it's usually only, and you're not shocked, but usually in the 13G, you're not an activist. So it usually just says, this is for investment purposes. Have a nice day. Like that's all it says. It never says anything other than that.
So I saw the 13G, as did you, and I know some of the people at some of the firms that have filed these 13Gs, and I respect them. I know people who know of them, respect them. But as you said, my thing is, if you file a 13G, I don't even look at 13Gs because 13Gs never have information in them. They're passive investments. You never get anything interesting in a 13G.
And without reading it verbatim, it says, we are aware of the bid by the private equity firm, and we are going to be very focused and concerned that, we've been long-term shareholders for 2 years. Look, it says, don't steal the company from us. It says, we are on you. This bid is ridiculous. I'm paraphrasing. And it says, we are going to be monitoring this situation, which is basically saying we're going to vote no if you accept this 1080 bid or anything near it. I mean, that's what they're telling you. So when they bid 1080, the stock was $9. It was around $9 for 30 days before it. A lot of times these things, these deals, any deal, they use 30-day VWAPs. They do 60-day VWAPs. They use the day before a Reuters article came out that said they were looking to sell themselves. In this case, the most likely price you would use is the unaffected before they made the 1080 bid, the day before, which was $9. Okay. And it traded in a range of 840 to 950, 930 in the 30 to 60 days before. Okay. And they bid this 1080. And this is a good segue into how these things usually work. So if you look at the comp table, which Andrew had, I keep talking about this, so I wish I could share it with you guys. But you have to.
I'll include a link to the. Be nice listeners, and I'll include a link to the HRT comp table in the show notes for people who want to go look at it.
Which is, by the way, this thing that Andrew found, which I'm embarrassed to say I didn't know existed, was HRT was another majority minority squeeze out. There's no reason to get super into it. We're all going to get into it a little bit actually, because we're going to talk about the dynamics of how these squeeze outs work. HRT is a perfect example, and it just happened a few weeks ago. But Andrew found, it was an SEC filing, but I just didn't know that they posted these things, that CenterView, which is the preeminent firm that advises special committees for these squeeze outs. In fact, I didn't find a single squeeze out that they didn't advise. They were in Endeavor and Silver Lake. They were in all the other ones that I researched. People must just hire them automatically to represent the special committee. They prepared a 25 page deck for the special committee that explains everything we're kind of talking about, how these squeeze outs work, what historical premiums are paid, how long they take, whatever. Because remember, the special committee they're not professionals in squeeze outs. In fact, this special committee isn't even specialists in the stock market. Almost everyone on this board, remember, these are all handpicked by the private equity firm. They're like ex-government officials. And there's some entrepreneurs and stuff, but there's no stock market people. Now that's good and bad, right? They're not savvy when it comes to stock market. They're just not. They have literally not one of them has experience in the stock market or in financial services industry. So they have to rely on the special committee. So anyway, in that comp list, you can see that, a lot of these private equity firms, there's only two comps in the whole one, Weber and I keep getting the name wrong. It's Convey Health, I think it is. Does that sound right?
I think that's right. I'm looking right now. It was, Convey Health with TPG.
Yeah. So those two are the only real comps on there. You'll see. The rest of them are all strategic, which is a whole other ballgame, a whole other animal. And they bid higher than 18, 20% for their initial bid. They bid 35, 40, 45, 50% for their initial bid. And then their final bid was another 50% higher, or 15 or 25% higher, or whatever. Like big initial bids, 13D it, a few months of negotiation, and then you wake up to a takeout price. And remember, both of those examples did not give you majority of minority. So there was no provision to protect you from the special committee screwing this up. We have that provision here. They have made it unwaivable. So we are definitely going to get a vote here. So the odds of a steal are almost zero with 11% holders on this thing that have owned it for years. Okay. So that's very important. Our protection here at 1080 is it's not happening at 1080. Okay. It's just not happening. Okay. So where did the stock? So they bid 18%. They bid 18% higher than the $9. The stock traded to like 11, 11.10, 11.05, whatever. It drifted down. Right now it's 10.90. So it's 10 cents above the bid. Okay. Now, historically, that comp sheet that Andrew will show you on the link, the bids, and we looked at this a lot, Andrew and I, the bids, you tend to get an average of 15% bump. But again, that's not comparable to this. It includes all the strategic transactions, and it includes initial bids that were much higher.
Brett Coffrin, founder and lead trainer of Fundamental Edge, barely remembers his first year as a hedge fund analyst. Most of that year was spent in a blind panic. Was his research any good? Was he learning fast enough? What did his PM really want from him? Trading on the buy side was non-existent 15 years ago when Brett was a new analyst at Maverick. Then he actually got demoted. Then he worked harder, found mentors, and asked for uncomfortable feedback. Eventually, he turned it around, learning by osmosis from the talented people around him, and rose to managing director. But is this the best way to develop talent? Brett doesn't think so, and that's why he founded Fundamental Edge. The Fundamental Edge Analyst Academy provides students with the tools, frameworks, and confidence to excel in any fundamental equity analyst seat in the industry. Lose the panic and fast-track your career on the buy side. Find out more info about their next cohort at fundamentedge.com/YAFP, or just see a link in the show notes.
As you're saying, I initially focused on that initial to final bid bump, which is about 15% is the median. And that was what I was initially focused on. Where you're going and where I've kind of come is, hey, actually what you want to look at is the final bid to the unaffected price. And that the median there is 60%. And some of that is there's one or two that are big boy premiums. But again, this is median. This is median, not so. Yeah, I kind of think, look, it's a private equity firm. They're very sophisticated. They probably knew, hey, could we bid 12 on the first bid? Sure. But then we're going to be really up a creek without a paddle when we go to negotiate. Like the way I think they probably looked at it is roughly 20% bid for the first bid. Maybe we bump it 20% when we get a final deal done. And hopefully we get that over the finish line. But majority minority, got another 10% in our back pocket if we need to bump it. And that would get you to roughly a 50% premium, if not a 40% premium, thinking that first. So that's kind of how I've been thinking about it. I don't know if you agree, disagree.
I agree completely. But the beauty of this is you're not just focused on comparable transactions. We can look at what this company's worth as an LBO, as a public company, and they're stealing it at a 40 or 45% bid. So
let's go talk about, because one of the things I like, and you hit on this immediately, one of the things we both like is a lot of these things, when you look at them, like these were private equity backed companies. So they come public and they come public with 8 times leverage, and they use the IPO proceeds to pay down to 6. Right. And then after a few years, they're at 4.5 times leverage. And then if a private equity firm wants to take them private, they need to put new equity capital. This is a very levered company. Here, because TH has grown so much and because they generate so much free cash flow, they are basically net debt zero. And they generate, there it is. You know, if
they generate probably $100 million in free cash flow. I don't even know the exact number, but it's $200 million to EBITDA with a very low CapEx. It's like a 25 million CapEx number, and no interest, of course, because there's no debt. So yeah.
And so they've got, and I do want to talk share buybacks in a second, but so they've got roughly 35 million shares outstanding. If they 35 million in the free float, if they bump this to 12, you're talking about a little bit more than a $400 million equity check to take this out. That would be 2 times EBITDA if they just levered it up with if they levered the whole business up to 2 times. So I think what you and I both like here is the private equity firm, assuming they can get this done for a 20 to 30% bump, they're not even going to have to take equity out their pocket. In fact, you could imagine a scenario where they go and they say, hey, we've historically levered this up 4 times. We're taking this to 4 times leverage. We're going to use 2.5 or 3 turns to pay all the minority shareholders. And we're going to take out a 1x EBITDA check for the rest of it. So they could actually take cash back. So that's what I love. The low leverage, low multiple here opens up a lot of optionality.
There are two important points in this subject. So first of all, Andrew said that often these companies are 4 or 5, like the private equity LBOs that go public are 4 or 5 times leverage. This one was. So to be clear, when they bid, when it was, again, it was a distressed company, but when they bid $1.50 in 2020, it was 5 times levered. There's about 100 million in EBITDA, and I guess 500 million in debt. I didn't look exactly the number. I just read the press release. I was doing the research I mean, there was 100 million EBITDA. So it must have been $500 million debt. And then in the March 2021 earnings release, when they killed the bid, they said they were aiming to be 4 times levered by the end of 2021. That's the first part. The second part, just to go back to that event, the bid in 2021, that stock was a rocket ship from the minute they put the bid in to when they killed the bid. It never went down. So it was trading way over $1.50 by the time the bid got killed. So it wasn't a situation where like, oh, if you owned it, you got burned by the private equity firm because it went back down to $1. No, they were trying to steal it. They couldn't come to an agreement with the special committee because everything was going right. I think the stock was like $3 within a few months of the bid.
Yeah. I mean, remember, this was a highly levered company. They made the bid literally like close to the COVID lows, early to mid-November. Vaccines were coming. People were coming across the border. Like they were just getting the government business really spinning. So there's one other thing I want to point out here. So HRT is the reason I got interested in this, right? So HRT is the company. It's got the comp table. I'll include a link in the show notes. The other thing that I thought was really interesting was HRT was majority controlled. And what happened was in the year prior to the private equity firm making the bid, HRT was very aggressively buying back stock.
Thanks for bringing it up.
The other thing I like about TH is they've had a share buyback plan in place for a while, but they didn't start executing on it until, you can read this in the 10K, until January 2024, when the stock bottoms after they get the new business and reset the earnings. And they buy back shares pretty aggressively. And you can read it in the 10K from January until March 2024. And that's all we know. I'm sure they're not buying back shares while the special committee's out. But that's important to me for one, pattern recognition reasons. We saw HRT, private equity controlled, buy back aggressively to shrink the minority and to make the bid. And two, it speaks to everyone involved here sees the value. They see the cash flow. They were trying to buy it back. I just think for both combination, again, nothing's guaranteed. There's risk in everything. But I think that combination really speaks to, hey, we're probably going higher. We're probably getting a bump.
We can get that was the last really important point I want to make. And I think the risks part, we can get to the risk section now. There are risks here. There's in every stock, of course. But I was just talking to my wife about this. She was like, what company are you talking about? First, she all made fun of me for being on someone's podcast. She's like, you're going to be on a podcast.
It's going to be famous. Who makes fun of someone for being famous?
I didn't want to tell her that I was already on Andrew's podcast in 2020. By the way, that was BMYRT, and it didn't work out so well. So I hope this one works out better than that one worked out, but we'll see what happens in the future with that. But anyway, I was telling her what they did. But, I'm like, I'm just a casual company that houses unaccompanied migrants at the border. And I said, I was trying to think, Andrew, I think we were talking about this, but maybe not. I was trying to think how, from a business perspective, we can get screwed here, like wake up to multiple standard deviation, risk. It's not them canceling the contract. That contract's up for renewal in November. And pretty much everybody thinks it'll be auto-renewed for the next 5 years. That's one of the bear cases of this, is that it's very important.
But let's talk. Do you want to finish that, or do you want to talk about the contract?
There was one other risk that you might, it's ridiculous, but I think it should be noted, is since that's what their job is housing unaccompanied minors, you can wake up tomorrow to a New York Times article that, there's sexual assault going on in the facility. And the government's like, we're done with you. And the stock goes down, 50% the next day. So a real black swan that could definitely happen. I mean, I don't know. Yeah,
you are 100% correct. There are definitely risks there. I think I would take some comfort in this is not the only person that's doing housing for the government. I think about the for-profit prisons and everything.
Yeah, of course,
and it's a big business. They're very incentivized to get compliance correct. And it's not to say that crazy things can't happen, but generally you get really hurt when crazy things, it runs endemic through the system. And I would just think here, like, as you said, board of directors with former government people, anything crazy can happen, but I think
that was the one risk. I know you were talking about the other risk is, let's talk about breaks, but did you want to take that?
Yeah, just so the contract, I think a lot of people have gotten scared about the contract. So the way this contract is structured, and I am no government contracting expert, but it's IDIQ, indefinite delivery, indefinite quantity is, I believe, what it stands for. And what that means is it's a series of 1-year deals with basically auto renew options. But people are really scared that, you go to November and the auto renew is about to come up and the government says, actually, thank you for your service. We don't need you anymore. And Yes, that is a risk, but I would just counter it with two things, and I'd love to hear your pushback on these. A, the government is desperate for places to house these unaccompanied minors. Demand for these facilities is going up, not down, and it's going to keep going up unless, we basically shut the border down. And you could say, oh, what if we get an immigrant deal and stuff? And I'd say, oh, you poor naive child. I don't think we're getting anything anytime soon. But my other counter to that would be, okay, that will stop the inflow, but it still takes 2 to 5 years to process these people. It's not like the demand is going anywhere anytime soon. So that would be one. And, IDIQs are not uncommon in terms of major contracts. It's just one of the ways the government does delivery. And I would kind of think the private equity firm, when they made this deal, I mean, they have the chairman of the board. I am sure that they've done extremely deep work. They knew the contract when they were negotiating. Again, this contract was just awarded in November, and the government, we'll talk about bull cases, the government has another contract that's going to get awarded in the back half of this year. I'm sure that they know the government, almost come hell or high water, is going to be renewing this deal. So I don't know if you want to add anything there.
Really, the most important part here is the 65% holder. I mean, Andrew and I don't know anything in the first place, but they definitely know much more than Andrew and I know. And they're not under any kind of, requirement to buy out this company. I mean, if this isn't the end of your mark. This isn't, there is probably some impetus because the fund is 12 years old, but they could then, sell the company, or they could do secondaries. They could do secondaries in the whole if they thought this was worth 5 and it was trading at.
Or forget, what else they could do? Again, this is a no leverage business. They could take it up to 2 times EBITDA and do a big dividend recap, right? If they said, hey, if we sell, nobody wants to buy from us, they're going to think we've got inside information. No one's going to begrudge them for doing a dividend recap. Like, there's a lot of ways that they can start getting money back.
$400 million would be $4 a share. You pull out a lot of capital. It's only trading at 9. So exactly. So that's what gives me most comfort, is that they wouldn't be involved in this and wanted to buy more of it if there was really tail risk with these.
Again, anything bad can happen. They wouldn't have made the bid. They wouldn't have been buying back shares earlier this year. Like, I just don't think they would. Quick bull case. Again, I mentioned when I was going through my background, there were 3 contracts to get awarded.
Before we do the bull case, just the Trump.
Yeah. Oh, Trump. Great. Yeah.
People love bringing up Trump. What if Trump gets elected? Doesn't that mean that these facilities get shut down, whatever? It's pretty much a nothing burger. If you pull up, their deck from November, they got awarded contracts when Trump was president. As Andrew says, there's going to be a need to house these unaccompanied minors for years to come. Even when, even if he tries to shut the whole border down completely, you can't shut the border down. It's not possible. You build the biggest wall in the world.
But, hey, I mean, even if you do, again, you've got the stock of people here, so you're shutting off the flow, but you have to house these people, because I'm pretty sure the last thing they want to do is just be like, all right, we've got 50,000 people in these facilities. Let's shut the facilities down and just let them run,
Also, be very clear, this is a special situation. So a lot of Andrew's pitches in these podcasts are like long-term, value plays. This will be resolved by the election. And I'm pretty sure that the majority holder, when they bid in March, knew they wouldn't know who was going to be elected in November. And right now the election market says 50-50. They wouldn't be bidding. They would just wait until the election to do this.
And that brings me nicely to the bull case, because look, again, it's not like the election is known, right? They didn't buy all the stock back in January and February and then make the bid in March without knowing the election was coming up. I'm sure they have an idea. And they also probably have an idea that the government has one more contract outstanding. And if they win, which they very may well could, the stock would go a lot higher. Earnings would be a lot higher. It would be great for them. So to me, like, what I kind of see is, I see a situation where you've got a majority owner who looks at the stock and says, oh my God, there's a lot of value here. I could probably lever this company up and basically take minorities out for almost free. And if I buy it now, I'm buying it too cheap, and I get actually call option on winning another contract or all this other stuff. So that's kind of how I've been thinking through the situation. How about you?
Well, and they probably have, they have 1-2 contracts. They have not just this one. They have another contract too, I believe, for housing migrants. But I bet you they have a pretty good view on that 3rd contract. And if they won the last 2, it's probably more than a coin flip that the government gives them this contract. The other really bull case on this company is they believe they have line of sight into $500 million of organic and inorganic growth CapEx over the next few years. And they've shown their return profile on these projects. This is the kind of projects we're talking about, winning bids and so forth. They're enormous returns on invested capital. So if I told you, your private equity firm, If I told you could buy a cash guzzling business at 7 times EBITDA, that's not levered. We'd have to lever it to get to the 7 times EBITDA. You put nothing up. Okay. By the way, it's funny where we live in where 2 times levered is levered. As Andrew says, these things used to be like 7, 8 times levered. When I was pitching this idea to somebody recently, they said a business like this would have been 7 times levered in a private equity.
It was 4 or 5, but when it was, again, it was mostly oil and gas, which is much more cyclical. So it was 4 or 5 just 4 years ago. I mean, yeah.
And remember, these revenues are really stable. Now, yes, they can lose the contract 5, 10, 15 years from now. The idea is that there's other contracts, the business ebbs and flows. They say in their deck, they have 95% retention on contracts. Now, again, the government business is different than the oil and gas business. But so that's the second bull case is that $500 million of growth CapEx, just buying a value business at 7 times EBITDA with no growth works. The math works. You lever it up a little bit. It has a double-digit free cash flow yield, and you ride off to the sunset. But if I can then use a revolver, which they have, and that's what they do. So they'll lever it up to $400 million. They'll have another revolver of $150, $200 million on top of that. And they'll be able to put money into organic, inorganic projects and grow this EBITDA from 200 to 300 to maybe 350. They can exit this thing at 8 times, maybe 8.5 times EBITDA to another private equity firm. It would be worth more than double the current stock price. Forget about how much they'll make. They make way more than that because they're levering up. So the actual money to them would be astronomical. Before I forget, there's a slide in there. You should all look at their November slide deck. It's pretty hilarious. They have a slide where they comp it to other industries. And they're like, we trade at 5 times EBITDA. These trade at 9 times EBITDA. These are our, free cash flow characteristics. These are their free cash flow characteristics. We should be 9 times EBITDA. I have a little bit of issue with that slide. I'd rather like lower margin free cash flow businesses so that they're less likely to be like cut by the government or people saying, hey, you're making too much money here. Like you should be making less.
I mean, the government making too much money, that's definitely yours. Just to yes and what you said, this private equity firm TDR, and I believe it's through their legacy Aero position, a company that has, it's not the same business, but it has similar characteristics, is WillScot Mobile. The ticker there is WSC, rental, and go look at that chart. It spits off cash. It's a rental, temporary storage for the most part, but that has done incredibly because it spits off cash, and they have done so many different accretive roll-up bolt-on acquisitions. And this company has been telling you for the past 2 years, I mean, this was formed from a bolt-on. They've been telling you for the past 2 years, we want to go do bolt-ons.
My gut is the private assets trade at 5 times EBITDA is my gut.
So there's a company, Civeo, the ticker is CVEO. It was a spinoff multiple years ago. It trades for about 5 times EBITDA, right? And spits off a lot of cash. That's all oil and gas for the most part from memory. I think there might be coal too, but it's very similar, but it trades at 5 times. And you could just imagine, take TH private at this multiple, go buy Civeo, bolt them together, lever it up, spew off a lot of cash flow, do one more deal, take it private or sell it to the next private equity firm. I mean, you'd be talking about incredible IRRs from there.
Their goal here is not to republic. We both know this, of course, but just to say it out loud, their goal here to exit will not be to bring this public again. It'll be to definitely trade it to another private equity firm. I don't even know if they even go the step of doing a dividend recap in a few years. They'll just trade it, and they'll trade it for a multiple that's higher than it's trading at when they take it out. And they have pretty good confidence in the revenue base and the growth base to get to that exit.
Or sell it to strategic. And the one other thing I wanted to mention is, one of the reasons these things are so great for roll-ups is A, buying low multiples, put a lot of leverage, great free cash flow characteristics. But B, I mean, WillScot Mobile is literally like metal cubes, right? Yeah. I buy your metal cubes, I fire you, like all the G&A is gone. So it's hugely synergistic in terms of cost synergy. So TH goes and buys, $50, $100 million worth of competitors, fire all the G&A, buy it 5 times, you turn it into 4 times. I mean, just go running.
There's 2 things I want to touch on before we wrap up, or if there's more.
No.
We're on the risk side. So the only negative thing I found through all my research was that the management team got all these stock appreciation rights, which are like phantom stock. They got them in 2021 at the lows, so it was like $1.50 strike or something. and they vested in 2 years and 3 years. And the entire management team sold the vested amount in 2023. I believe it was like in early March. It was within a few weeks of when it vested, probably when their window opened, okay? They did it again. They sold the entire vested amount a couple of weeks ago, all 4 management players, and they did it 3 days apart, which is super weird. And you would be like, why would they do that if they know there's going to be a big bump coming? The best I can come up with is that they have been selling stock for years. They're not selling stock now. So the CEO has been selling stock for the last 2 years. No stock's been sold since the bid, just these SARs. That it was kind of like an automatic thing that they just were going to do once they vested. They're not part of the special committee. They're not part of the buyout group. In fact, if you recall, the private equity firm deleted the sentence about how management is going to be rolling stock in this deal. So for all we know, and actually, I don't want to say something that, and now I want to get Andrew all scared. I don't want to say anything that's controversial, but someone did tell me today that there might have been some conflict between this private equity firm and the CEO over the last few years.
I think I can help a little bit here. So in late 2021 or early 2022, the CEO said that he was going to leave Target Hospitality, right? And then if you go back, this is a May 2022 press release. He reached an agreement with Target to stay long till June 2025. So he signed a 3-year extension. And I think it's possible that he was ready to move. They didn't find the right, whatever it is. But we're in 2024 right now, right? By the time this deal completes, it's probably going to be late 2024. Like the CEO might be ready to retire.
Probably
also might say, hey, maybe TDR is pissed at them because the last deal wasn't great. They think there was a bungled sales process in the summer of 2023. Like TDR might be ready to move on. So I'm with you. Like it's kind of weird. You would think if they thought a big bump was coming, they would just
hold it for 3 more months. You know,
yeah.
But CEO has 1.4 million or 1.3 million shares, by the way. So while he did sell like 350,000 or 400,000 in these SARs, he's very incentivized to get the best price. He's not even involved in the negotiations. He's not in the special committee. And he's not going to be part of the majority minority. Actually, he will. He'll have a vote. I'm pretty sure he's going to vote for it, even if he's not rolling. But
how funny would it be if the CEO came out and was like, "Hey,
great.
I'm voting against this. I've got a board seat. I'm the CEO. Screw it. I'm out."
And I want a jet. And but it's funny. Even though that's the bearish point I have, there is a bullish point. So those SARs can be settled by the company either in stock or in cash. And both in 2023 and in 2024, the company elected to pay them cash above the bid. So it was 1090 or 1088 or whatever it was. And the board, whoever decides this, it's obviously not the CEO, said, no, we're not issuing them stock so they could sell in the open market. We're just going to give them the money, the 1090 minus the 130. You clearly don't do that if you don't think the stock is undervalued. It's the equivalent of a buyback.
Yeah,
right? It's exactly the same thing as a buyback. You would issue the shares and let them sell in the open market. So that's very bullish. The way I look at it from a break standpoint, again, my final wrap on risk is let's say that this breaks for one of two reasons. The market's been terrible. Okay, so the market keeps going down. I think this is my favorite idea in a bad market because none of this math changes. This is contractual revenues. The interest rates they're going to borrow at were probably always going to be 10, 12%. A month ago, today, a month from now, like it's not going to change what that junk debt costs for them to borrow a very low amount of turns on the leverage. So that's a risk. The market's always a risk. But the bigger risk is special committee and the private equity firm can't agree on a price. So they want, the special committee wants 18, they want to pay 14. They don't agree. They usually agree, by the way, but they don't always agree. And it breaks. Assuming you don't find out why it breaks, they just announced that we're no longer bidding for this company. Let's say it goes back to 9 or 850 or 950 or whatever. So you come up with what your break is. Everything we said about this company still remains. At 9, you own this thing at 4.5 times EBITDA. And you have a 65% holder who's completely aligned with you that has to exit this position in the next, 12, 24, 36 months.
To yes and you, I mean, if it breaks, right?
I love when you do that, me. I need you around the house.
Say again?
I need you around the house with my kids and my family. I'm going to be like, you guys need to do your homework and eat your vegetables. And here's
yes, and I need you to exercise as well. No, just to yes, Andrew. I mean, if it breaks, you mentioned the 2020 letter said we don't want to sell to anyone else. The 2024 letter does not say that. So if TDR doesn't take this, I'd have to imagine it's because the special committee goes and shops and says, hey, TDR, you guys won't go above 14. They come out and say, hey, we've rejected TDR. We're running a full process and we're going to get more. So I don't think this can be a public company anymore with TDR open to selling, right? If they said, hey, we won't sell to anyone, then you could rescind and pass. But if they say we'll sell to anyone, then the special committee has to take the highest bid or go find a better one. Go ahead.
They deleted, we want to be long-term shareholders of the company. We don't care if you reject this. And so, not to jump all around, I know we're running an hour, so this will be the last thing we talk about so we can get the hell out of here. But I could talk forever. And I guess your viewers could just close the YouTube, so we could talk for 2 more hours.
They'd never do that. I can't talk forever because I've been a little sick and I'm not going to have a voice in 5 minutes.
Well, that's what I wanted to say which is more of like a intro to squeeze outs, was we never really talked about why companies do the majority minority, how these different things progress. The reason why, the only reason why you would take out that we will not sell to anybody else is, again, it's always about lawsuits. So if you have that in there, okay, and you still allow a majority of minority, you still have a small window of lawsuits after this thing closes. Because you could say, the special committee did not shop this, thoroughly shop it, and we were between a rock and a hard place as shareholders. We voted for it, but we had no other options because it's going to go to 9 if we don't take the 13. And you didn't let people see whether anyone wanted to buy it for 15 or 16. So there is a chance, it's not a bad thing, that they took that out again to make it the most kosher way to buy this so that they do not have lawsuits after this is over. They're totally going by the book here. There's a majority minority. They says shop it. They're telling you to shop it. I mean, I don't think I've ever seen that before, Andrew. Do you remember a time you've seen say shop it?
No.
Yeah. So anyway, I love it. It's one of my favorite ideas. I know. I'm very passionate about it. I really do love it. I mean, so it's trading 10 cents over the bid. So why don't we talk? Actually, let's wrap with this. This is a pretty good. I think this is a good way to talk about merger arb a little bit. So how do I value it? How do we think it should trade? We have never talked about this. But if you think that this should have a traditional 15% kind of bump, okay, that would get you to the low 12s, like 12.20, I think 12.30, something like that.
12.42 would be a 15%.
Okay. So the way you do this, in case you're wondering if you're not familiar with merger arb, is you have to then see how long it's going to take for them to sign the deal. And then you have to see how long it's going to take for it to close. And then you try to figure out what deals trade at once they're signed. Now, deals like this trade very, very tight. Tight means you don't get paid a lot of money. You don't get paid a lot of money. Once this is announced, the odds of it breaking is virtually zero. Because even if like the government pulled a contract, they own 65%, and the merger agreement will probably say that's not a material adverse clause. Like it's probably going to be in there. Like bad things can happen at the, at the facility, and you can't get out of this. But they own 65%.
The other reason I don't know if they could do that because I don't think a debt lender would be okay with, oh, yeah, you lost the government contract 3 weeks ago, but here's a $400 million check. But the counter is because these guys own 65%, this is going to close fast. It's going to close really fast. So
you have to get a vote. You have to get the majority minority. It's actually not. I'm going to push back a little bit there. They have to do a certain filing, I think, for the majority minority because they're controlling it. So it's not like a 3-month close. It might be a 4-month close. It might be.
I was thinking you could close within 90 days because it's just file a proxy, get feedback from the SEC, and then close.
Yeah. I think let's call it 4 months, and let's call it the fact that they removed the language about not willing to sell to somebody else. That adds time to this process. Now, we don't know when they originally approached the committee. In the press release for the company, I also find this pretty interesting. The company says, we just got this bid and we're going to hire, people to advise us. Interestingly, it was the exact same language they used, literally the identical press release in October of 2020. When the bid broke in 2020, it was March of 2021, which kind of speaks to that. They really did just get it then. It took about 4 months. The stock was working. They couldn't agree on a price. We'll never know the background there. We might know the background there if this happens. It might read about it in the proxy. But that's why I think we might still be 3 up to 4 months away from this being concluded, because they have to run a full process now. Now, usually nobody wants to bid against a 65% holder. If you're a private equity firm and you're told, hey, I have this great, a banker calls you up, I have this great idea. It's everything we just told you, all these great financial metrics. Are you interested in participating in this process? Yeah, what's the catch? Oh, well, the catch is there's a 65% private equity firm that's already said they want to bid for it. And you're just along for the ride because it's fun to have you along and it's good for lawsuits in the future. And they're going to outbid you or match you anything you say. So if you want to spend millions of dollars of due diligence and fly your plane, to all of our facilities and waste all your time, please come give me your best bid. They usually don't bid. Okay. They usually aren't even involved. Now, we don't know what's going on here. There's a chance that they are interested in selling the company to a third party at a really good price. Again, I think they would have just done that in a private setting. It would have been a private process, and we would have just woken up to a deal. So I do think they want to buy it. I don't think it's going to be a long, arduous process with third parties. My guess is this is resolved between 60 and 120 days, which means if you use the midpoint, 90 days and 4 months to close, there's 2 different data points here. So one is 90 days for it to be bumped 15%. And then, 4 months to close. And where will it trade each of those? I promise I'm almost done here. So let's say it goes for 12.32 in 90 days. Where does it trade? It would usually probably trade at like a 2% discount, because that's an 8% or a 7% yield to close if you annualize it. Okay. So a 2% discount on 12.32 is whatever it is, 12.10 or something like that. It's trading at 10.90 right now. Okay. So 10.90 to 12.10 over the next 3 months, that's, pretty uncorrelated, is pretty good. By the way, I think that's the low end. I don't think they can get this thing through less than 13 is my personal opinion. 13 to 40% premium. The math all works. Tell me I'm wrong, Andrew.
No, I agree. So I think the bump is likely to be, as we discussed, I initially centered on about a 15% bump, and I've come to the opinion that a bump is likely to be bigger for especially the 13G reasons we talked about and the low initial bid. But the way I've kind of been doing my math is like, a little decision tree with, hey, a bonanza bump, which I'm going to call a 30% bump, which we could get bigger. So that would be to the low 14s, 10% chance of that, 70% chance of a 15% bump, which again, I actually think is on the lower end now. A 10% chance that these guys are just like F it and try and get a 1080 deal through. That's actually probably too high, but there is some.
No way.
And then I've got a 5% chance of this not going through and this going to 9, which I actually think is crazy. And then there is a 5% like tail risk, disaster, lose the government contract. You'd still have the oil and gas, and then it goes to 4. But when I sum all those together, I get to 1185, time discount that back. I get to the same math you do. I think I'm a little surprised it's not in the mid 11s right now.
I think it should be about 1150. And even then you should never be a holder. You should be a buyer or seller. But I think I would hold my position still. It would have to be, I think that's my sanity check here. If this started going into the 12s, I would trim it. But mind you, this is the disclaimer that Andrew didn't tell you. I size things very big personally.
I'm not even compliance. If you say you're sizing, compliance is going to come down on us with the.
I'm pretty sure you can't get in trouble for anything that I say.
One thing that strikes me just on, you and I both kind of settled down mid 11s. It does strike me. We played a lot of the take private MLPs over the past few years, and most of the take private MLPs, now a lot of different dynamics, but most of them did trade for about a 5% premium to the initial bid.
I'll tell you why that is. Because the initial bid in almost all of those is like last trade.
True. But most of them did trade for a premium. And again, right now it's a really interesting time. There are a lot of these take privates where 20 to 40% owners are making bids, and some of them are trading way below, and a few of them are trading a little above. But this is my favorite. This is my favorite.
Like all the best investors, Fundamental Edge believes that the learning process never truly ends. That's why the Analyst Academy is just the beginning of their journey with you. Fundamental Edge alumni gain access to exclusive content, such as the Guest Speaker Series, which recently featured Rich Falk-Wallace of Arcana, who discussed the role of factors in fundamental investing. Alumni can also look forward to frequent webinars, case studies, and content from industry partners. Fundamental Edge recently hosted its first Analyst Spring Training Conference in Scottsdale, Arizona. Attendees enjoyed a range of speakers, judged a stock split competition, and network with fellow alumni. Mark your calendars for the spring of 2025 for the next conference. Visit fundamenteddge.com/YAFP or just see a link in the show notes for more information about the next Academy cohort.
Anyway, Matt, I am losing my voice. Any last thoughts before we wrap this up?
It was so much fun, and it's like it shows me it's fun because, I mean, when you know this, it's like this business is a drug, and it's like when you find an idea that you think is so interesting, and part of me wants like the private equity firm to watch your YouTube. I want you to send to them, and they want to be like, I want them to be like, fuck, these fucking guys are onto us. They're gonna stop getting we want the stock lower so that we don't, our premium is bigger.
That's dynamic we haven't talked about yet either. Yeah. Sometimes like you and I come on and do a podcast on Apple. What we say doesn't matter. We're speaking as right. One of the interesting things about these squeeze outs is eyeballs matter. If nobody cared and the stock was at 1020, that increases the likelihood that
they didn't go through.
Like I would encourage people should go read Consolidated, CNSL. They had a squeeze out. Now the private equity firm there owned like 30 or 40%. If you read, it is very clear that minority shareholders are sending letters into the special committee and saying, we think we are getting stolen. And because of that, the special committee is able to get every last penny from the buyer. And here, I think if TDR buys TH for $12.50, I will be very sad. They will get my shares and I will make a nice profit, but I think they will have stolen the company. So every voice, every buyer actually matters, because what are we going to do? After the Q1 earnings come out, you and I are both going to send a letter to the special committee. We're not coordinating. We're not a group. I'm just saying what we're most
likely. We are 5% together. I don't think that'd be even illegal if we were coordinated.
I just never want to. But what every informed shareholder should do is send a letter to the special committee being like, hey, here's my valuation. I don't think you cannot take 1080. You cannot take 1150. This is what is fair. And you're probably never going to get what's fair in a squeeze out transaction, but those letters give the special committee extra leg to stand behind and show them if you don't stand up, you're probably going to get hit with a lawsuit. So any last words here, Matt?
My last word actually is that. So if we do get screwed with a bad price, now, yes, there's a majority minority vote, and there's the language removed. So they've really protected themselves legally, but it's not ever foolproof. So like if this closes at 1180, let's say, you can own it. And then the way the lawsuits work is whoever owns it at the close gets the lawsuit. It's a free roll. The lawyers fund the lawsuits. They get discovery. Let's say in discovery, we find out that they did all sorts of shenanigans behind closed doors to dissuade other bidders. Let's say discovery comes out and they knew they were going to win this contract in the fall. All these things have happened before. That happened with.
I know. I feel so naive because I'm like, no way would a special committee sell when they knew that there was a contract coming. And then you'll find like come at Discovery. Yeah, they knew that they literally found $500 million of gold sitting under their headquarters.
It was in there in the Weber. So that's another piece of cushion here and additive to where, again, it's not super relevant today, but if we get screwed and hosed in the price, you have a free look. At the close, which I will own this. I can tell you right now, I'll own this at the close for that lawsuit because they work. They really do work.
Matt, this was a blast. I was like in my head, oh, this is going to be a quick 30, 45-minute podcast. No, hour and 15. We're going. I'm losing my voice, but this has been a blast. I'm going to remind everyone, nothing on this podcast was financial advice. We mentioned lawsuits at the end. Nothing on this podcast was legal advice. Matt and I, we both went to the best school in the South, Tulane, but neither of us went to law school.
Have you been sued before, Andrew?
Why would you ask that? I don't.
You're so worried about being sued. I always find it so funny. People that put those disclaimers like at the bottom. I put it on my YouTubes. Oh, you'll show my YouTube. By the way, if you think if you like Andrew's polished YouTube channel, my YouTube channel is not polished. But anyway, I joked when I first did it. When I first did my first YouTube, my friend, a lawyer, was like, "You should put a disclaimer." I do. I put a disclaimer there. It says not investment advice. I always would have found it funny if like Bernie Madoff. In every monthly statement, it was like nothing on here should be considered, returns. I feel like it doesn't do anything to disclaimer.
The reason I'm so careful is A, because I don't want people to get I want people to know like everything has risk.
No one should be buying what Tulane. No one should be listening to Tulane alums pitching stocks on a YouTube channel for free. Like you shouldn't be listening to us. It's totally true.
That's probably true. I do think all the time I'm like, man, I have no clue. In every aspect of my life, I have basically no clue what I'm doing. Like, Being a parent, no clue. Raising a dog, no clue. Only thing I'm really good at is board games, man. That's pretty much the only thing.
Well, you're better at one more thing than I am, so that's good. Yeah,
it was a ton of fun. I'm going to remind everyone: not legal advice, not financial advice. Just because Matt made me want to say it again. We're going to have you on for a third podcast on the next exciting video we have. But this was great. Talk to you soon, buddy.
Bye. Thank you.
A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.